Welcome back. Well, the markets continue to hold well in the green, but you're not able to build onto those gains actually today. At least for the time being, we're holding close at around 21,700. The Nifty Bank at around 47,500 odd. But time to get straight to another exclusive market talk. We have Vikash Kumar Jain, the India strategist at CLSA, who joins us on the show. Hi, Vikash. Good to see you in and wishing you, your team, a cracker of a year in terms of 2024. 2023 was very good. So hopefully things look up for equity markets. Well, Vikash, we normally see this pre-election rally. But it seems this time around, the markets took the state election result with both hands and they started factoring some part of that in. Do you think most of that pre-election rally is in the price, or do we have more to go?
Yeah, so I think November, December was particularly very good. And if you see two big events, market got super excited about. Of course, we had our own state elections where markets started believing that this is perhaps a very accurate reflection of what will happen at the national election. And secondly, US Fed suddenly reducing its hawkish stance, or maybe to the market's reading, turning dovish. I think both of those happened in that two-month period. And we started the year with perhaps with that expectation of third term for the current government already largely baked in, plus 160 bips of rate cut expected from Fed as per market expectations when we started the year, as compared to 75 bips. Just to digest that, 160 bips basically means rate cuts in 6.5 of the 8 meetings that Fed is supposed to have in this year. So that's the kind of expectations we started the market with. And to kind of maybe quantitatively look at that expectation, the one thing that we have is our proprietary India Bull Bear Index. It started at an extreme bullish level of over 95% bullish. So clearly, very elevated expectations to start the year with.
Got it. Vikash, hi. In your latest strategy note, you're basically saying that you prefer mega caps, banks, insurance, and energy. All right. So that's a broad kind of focus that you have. What makes the cut in terms of stocks within these pockets in the model portfolio? What are the top ideas?
So I think, the top ideas, without being stock specific, that if the report is with you, you already had the top ideas. But the broad thought process when we are constructing the focus portfolio, and we also had another report where the title of the note was "Greed is not good." I think that's really the theme with which we are working with for 2024. Like we discussed, the starting point being quite, a lot of hope already baked into the starting point. In addition to that, if you also bring in the fact that our favored valuation benchmark is also quite extended, it's at a level where historically empirical evidence from that level, if you invest, returns have been very, very, very low over 1 or 2 year periods. So the portfolio construct is with the thought that it is unlikely to, this year is unlikely to see a runaway rally like last year. Of course, I hope that I'm wrong and we have a great rally, but it doesn't look like this year. So from that perspective, I am much more heavy on risk-reward mindset in the portfolio picks that we have. Clearly trying to protect downside, and wherever we see reasonable risk-reward, trying to play that upside. I think the benchmark to beat, to outperform, will not be very high. So that's really the thought process when selecting those names and sectors that we discussed.
And greed is not good. I'm assuming Vikash is
Gordon Gecko. He's not with Mr. Gecko, is he, Vikash?
Not for this year.
Okay.
Maybe next one.
Okay, just for this year. That's an important caveat as well. But Vikash, let's talk about the underperforming parts of the market, relatively underperforming. And we were talking about, FMCG and, for instance, even IT, which has been more patchy than anything. Are you expecting any sort of a shift over here? The problem is that in terms of earnings, the numbers are still not adding up for pure play staple companies. We're talking about this mid-single digit growth. But in terms of investor interest or just tactical portfolio shifts, do you see any interest coming back in this part of the market?
So of the different calls that we have in the model portfolio, our biggest out of consensus call is that we have zero weight in consumption, zero. So pretty big underweight in consumption. So the way we run it is it's a focused portfolio. We try and keep it high conviction, and we've avoided consumption for a long time, except for over the last 3 years when we've had this portfolio. There have been times when we've been involved with auto names, but in general, staples is something that we've never had in the portfolio in the last 3 years. Having said that, we need to be clear about the kind of companies that we are talking about. These are super high quality companies with a lot of respect. However, the environment, the investing environment has changed for them. That's because one concept which was largely forgotten in the last decade is back. Cost of capital is important in this environment. Yes, Fed rates are going to get cut, but we're not seeing anywhere close to zero rate is not what we are expecting. However, valuations for these companies, because they generally do not crash. These stock prices rarely crash. They at best will derate very gradually. I think we are in the midst of that derating process. There's still some of these stocks are available at, are still at 2.5-3% earnings yield at a time when US bond yields are over 4%. So the environment, the investing environment has changed. Cost of capital is a concept which is back. They're in a gradual derating process. There will be time tactically here and there when people think of these as good hiding places. But, the other thing which has changed is that we now see they're far more confident of earnings growth in Nifty. Talking of 14-15% kind of CAGR numbers. That's very different from where we started in the period of last decade when banks and many of these others were suffering from the excesses of the decade before. And earnings growth in Nifty was much lesser. And then 10-12% of what these companies were offering at a much lower valuation was something which was looking super exciting. That both of those things have changed. Valuations need to kind of correct to more palatable levels. Sure. And earnings growth, is already higher for the rest of the market.
No, Vikash, so let me come to the other, pole extreme of consumption, and that's discretionary. And look at what's happening, for instance, to these small jewelry stocks, right? I mean, the smallest of them. Yesterday, I saw the market cap was 700 crores, and today it's 800 crores, just because the market's bidding up anything and everything on the discretionary side. Yes, the property players are showing fantastic sales numbers, but again, there I go back to, the theme of your note. Greed is not good. So, I mean, how do you place your bets on the discretionary side then? What would you still buy and what would you avoid there?
So, the way to think about it is as market becomes extended, typically narratives shift away from 1 or 2 years. You start talking of trying to play the 3-year, 5-year story, although the fact is that the reverse should happen, but that's rarely the case. And some of these stories are very exciting when you want to say jewelry. The listed jewelry space is typically organized taking share from unorganized, in general over the next 4 to 5 years, disposable incomes rising for Indians. So it does fit pretty well. I'm just saying that there will perhaps, because we start with such expectations and most hopes baked in, there will be periods when there will be correction to those expectations. And then many of these elevated valuation areas will get corrected. But till that happens, clearly we'll play the 4-year, 5-year story. And where, a lot of these discretionary in general, rising disposable income in India fits pretty well as a theme. So I think that's what is happening. I believe that sometime in the first half, we will have jitters, which will perhaps correct our expectation and normalize it. Like, for example, when Fed speaks on 31st January, perhaps the Fed governor would realize that he had pushed the market a bit too ahead. And I would not be surprised to see him trying to bring back expectations to more normal level. As compared to the dot plot of 3 cuts, market bakes in 6 to 7 cuts. I think some of that needs to correct and normalize. I think that will be the opportunity for us to kind of get back into the market, maybe start thinking more on risk. Right now, we need to try and protect our downside.
Got that. Vikash, very well put. Briefly, is this budget going to be meaningful? It's a vote on account?
See, I think I'm not too hopeful because, what needs to be done, and a lot of people are talking about consumption. I don't really sense the government changing its supply side policy making approach. They believe that they have got a lot of success from it. Our discussions with many people, who are closer to policy making gives us that sense. So I don't see that changing per se. So I really doubt there'll be too many surprises. Anyway, it's more of a vote of account. I'm not too hopeful on any sector-specific, big changes right now. We'll have to wait for the next one, which is after elections.
All right, Vikash, we'll leave it there. Thank you very much. Good conversation as always with you, and hope to have you back soon again. Thanks indeed for taking out the time and being here.